Market Catalyst. I'm Julie Hyman. We're 30 minutes into the U.S. trading day. Let's get to the three market catalysts that we are watching this hour. First up, we break down the latest on President Trump's tax bill as it clears a key hurdle. Will it be indeed on the president's desk by July 4th? Plus, we dig into the latest jobs report and what it means for the Fed's path forward on rates. And how is inflation affecting the price of your 4th of July barbecue? We'll give you the numbers and get a read on the state of summer travel. All that and more coming up on Market Catalysts. Let's start with the check of the markets here. We're seeing actually stocks extend some of the early gains that we saw following a better than estimated jobs report. The headline number for June seeing a gain of 140,000 in payrolls and the unemployment rate ticking down to 4.1%. And even though some economists have told us that the underlying numbers don't look as strong, the market doesn't necessarily see it that way. And even with the odds of a rate cut in July coming down, stocks are rallying here. The Dow, the S&P, and the NASDAQ all higher, and the NASDAQ leading gains up 0.8%. A reminder, any higher close for the S&P 500 and the NASDAQ on this holiday shortened trading day, by the way. Markets close early today. Any gains for those two will be another record close for those two indexes. Let's talk about the bond market as well. As I said, we are seeing traders kind of changing their expectations of what we could see from the Fed. That means higher rates across the board here, yields moving up, not huge gains, but bigger on the shorter end than on the longer end of the curve. The 10-year yield up of 4 basis points, 4.33%. And we've got a live look at the floor of the House where Minority Speaker Hakeem Jeffries has been speaking on the chamber floor against the tax bill for more than 4 hours ahead of a final vote. Joining me now with the latest, Washington correspondent Ben Werschkul. Ben, is Jeffries just sort of delaying the inevitable at this point? It looks like probably that House Republicans have the votes, yes?
For sure, yeah. That appears to be what's going on here with Jeffries. This is what's known in congressional parlance as a magic minute, which allows him to speak for as long as he wants. I was just listening a couple minutes ago, and he was talking about the intricacies of state and local taxes, so he still seems to have a ways to go there. But the bottom line, as you pointed out at the top, is that this is headed for a vote in the coming hours, and Republicans do appear to have the votes together to get this done. The big breakthrough came at about 3 a.m. when House Speaker Mike Johnson was able to muscle through a procedural vote that only saw one Republican defection on that. That was the vote to kind of start this debate that will sort of end in the next few hours, and does appear likely to get this to President Trump's desk by his self-imposed July 4th deadline. This comes after we've been looking all week at these kind of fiscal conservatives and other objectors, which numbered in the dozens, literally as recently as yesterday, who gradually fell by the wayside. This comes in spite of the bill's multi-trillion-dollar price tags and healthcare cuts that we're going to be talking about for a long time. But it does appear that Trump's going to get a signing ceremony on the 4th of July if he wants it.
And Ben, there were some changes, right, that were made in the Senate before this came back to the House. There were certain things that weren't in there, that were taken out, that were put back in. For example, there had been a ban on states regulating AI. That came out. What do you see as sort of the most significant change or changes?
Yeah, that AI provision was a big one. This was closely watched by the tech community, and so that was a loss for them, who wanted this protection from state level protections. Two other ones I'd flag. One is green energy. This has been a real point of contention in the last couple of days. It's what spurred Elon Musk to get really involved in the bill in the last few days, at least from a distance on his social media. And this is because they added and subtracted a whole bunch of provisions in the last few days of the Senate about green energy. What we're left with in this bill is essentially the government stepping away from green energy in the coming years. One of the provisions that is happening sooner than some expected was that EV credits will phase out this year in September, and then some solar credits will phase out after that. There had been harsher provisions in there, essentially a headwind on the clean energy, but those were removed at the last minute. So it's essentially now the government sort of taking a step back from clean energy. The other big change is around the final price tag. One of the things I'm looking at this morning is how a bunch of business provisions, making them permanent, which you could argue is a more honest way of accounting this, is the main driver of an increased price tag. This came back to the House about $1 trillion more expensive than when the House passed it a few weeks ago, and that's because of things like R&D expensing being made permanent and other changes like that are going to increase the price tag, but is the sort of centerpiece of why this bill could lead to economic growth, at least from the White House projections.
Ben, thank you so much for this and your continuing coverage of the bill. Well, our next guest knows a thing or two about tax cuts in Washington and the negotiations around them. Joining us now is Kevin Brady, former chair of the House Ways and Means Committee and a key architect of President Trump's 2017 tax cuts. Thank you so much for being here. So I guess I would love your insight, first of all, as someone who knows how these negotiations work, maybe how this negotiation worked and how the folks in the House got this over the finish line over what were some pretty vocal objections.
Yeah, Julie, thanks for having me. So I've been in those rooms on these bills. Look, these major bills are incredibly difficult to pass, even more so when you've got a near zero majority in both the House and Senate. Really, the degree of difficulty goes up a lot. So my guess is most of those holdups wanted to see more savings, either in this bill or through future action. So my guess is a lot of conversation with the White House about the spending that they control, how they can work with Congress on reducing the size of the budget. And then because the Speaker has been hinting about a second reconciliation bill, maybe at the end of this year and another next year, what are more savings reductions that can be obtained there? So my guess is the bulk of those conversations were about deficit reduction, plus those who come from states with Medicaid, the way they finance it, that was changed in the Senate, certainly had questions about how that would apply, how that would be implemented. So my guess is those were the two areas. That's why the president, the vice president, the administration was involved directly in those talks with those lawmakers to provide them assurance that there'll be continued effort to address the deficit.
So there's the deficit on the one hand, and then there's the other issue. One of the other issues you mentioned is Medicaid funding. It does look like there will still be some cuts to Medicaid as a result of this bill. I've also seen reports about thousands of folks who could lose health insurance as a result of this bill. Should some of the Republicans who voted for this worry about re-election if indeed some of their constituents are going to be hit by these cuts?
Probably less than is being characterized, mainly because these aren't cuts. It's slowing the growth of Medicaid that will continue to grow through the next decade as well. And as you look at the savings that they created, none of which affect benefits in Medicaid, are focused on those who have Medicaid in two states, those who aren't eligible, improper payments, those who frankly are adult, capable of working. They're being asked to work part-time. Those, for most Americans, those are pretty reasonable reforms and savings on Medicaid because you want that money to go to the most vulnerable. So I think most of the questions there is every state finances it differently. They want to know how that's going to be impacted, again, and how the administration will, sort of implement the changes in the bill.
I'm also curious about, how much of a difference this bill is going to make to growth. Undoubtedly, the tax cut package that you helped pass back in 2017 helped spur some growth. And the bulk of this package is just that, right? It's an extension of those prior tax cuts. There are some other additions, but this is sort of being presented as a big, beautiful bill, a big game-changing bill, right? Is it really going to spur growth that much more than just the extension of the tax cuts?
Yeah, so clearly 2017 did spur growth. Economic growth certainly percentage point higher than projected. We led the G7 countries. Paycheck growth, I think, was the best outcome the first 3 years after the Tax Cuts and Jobs Act. Real wages, that is above inflation. Those first 3 years are the three highest years on record. So Americans were getting ahead in a big way. And we were so much more competitive around the world. This bill is really about locking in those pro-growth reforms, including that low, more competitive corporate rate, but preserving and making permanent, restoring those key provisions on innovation, like research and development and expensing, I think are very important. And they made, Julie, some smart, thoughtful changes in the international space that will really builds on 2017, allows our companies to be more competitive overseas, continues to attract foreign investment and intellectual property back to the United States. So from that standpoint, that certainty, restoring those key innovation provisions, I think are going to be very helpful to the economy.
I'm also curious, sort of to go back to the re-election question. Even if the cuts to Medicaid maybe aren't as dramatic as being portrayed, the individual level tax relief is clearly the greatest on the higher end of the income spectrum. And in this environment, yes, New York City is largely liberal, but when you see a win like we saw for Zohran Mamdani and that sort of movement sort of towards leftist populism, do you think that those kinds of cuts are going to end up coming back to bite Republicans?
No, I don't. And just like in 2017, by percentage, which is usually the fairest way of measuring anything, the tax relief is higher on the low and modest income Americans, less so by percentage on the higher earners. And in fact, after 2017, the result of that tax reform is that the higher earners are now shouldering a record high amount of the overall tax burden for individuals. The code became more progressive. This code actually both retains that progressiveness, but it also adds some of these issues. A higher standard deduction, really helpful for families. A higher child tax credit, also helpful as well. And then for those specific workers, the president was really dialed in on these tips in overtime and Social Security, which looks like will provide relief to about 88% of seniors. Most of them, on very modest incomes. So I think there will be less relief for the higher earners and far more relief proportionally to those modest workers.
Kevin Brady, thank you so much, Congressman. Appreciate it.
Thanks, Julie.
President Trump's trade war risks reigniting next week. A temporary pause on reciprocal tariffs is set to expire on July 9th. So far, only one full deal has been signed with a trading partner, that's the UK. President Trump and British Prime Minister Keir Starmer formally signed that agreement during the G7 summit. That deal lowers U.S. tariffs on British cars and aerospace parts, though levies on steel, aluminum, and pharmaceuticals are still being finalized. A few other frameworks have been announced with major partners. This week, President Trump, for example, announced a deal with Vietnam that allows American goods to enter Vietnam duty-free. After a strenuous few weeks of tit-for-tat tariffs between China and the U.S., the two have reached a partial agreement on rates, remember, back in May. Officials just recently agreed on a trade framework with the goal of easing tech restrictions and opening access to rare earth minerals. Other trading partners that the U.S. has been in talks with include India, Canada, South Korea, and the EU, though relations have been tense at times. These discussions have been a roller coaster for markets. The S&P 500 experienced its worst drop since the pandemic when, of course, Trump announced those reciprocal tariffs back in April. Since then, the index has recovered and then some, having hit multiple new record highs this week. We've got much more markets action coming up. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We're watching Meta, FedEx, and Oracle. First up, let's talk Meta. It's getting an upgrade to hold from underperform from Needham's Laura Martin. The analyst citing two reasons for the upgrade. One, rising estimates based on the firm's channel checks. And two, Meta's employee productivity stronger than 8 other mega cap tech firms, including Apple, Amazon, and Alphabet. Still, Needham remains on the sidelines due to several factors, including downside pressure on Meta's margins, regulatory risks, and a strategy that they believe wastes capital. The share's up just about 0.6%. Next, FedEx getting a double upgrade to outperform from underperform over BNP Paribas. The analyst there saying he believes the stock is oversold as it is outperforming rival UPS in both volume and yield growth. This comes just a week after the stock faced a steep sell-off after investors were disappointed that the company declined to give full-year earnings and profit forecasts for fiscal 2026 due to the uncertainty around trade policy. And Oracle is expanding its relationship with OpenAI. The AI company will rent about 4.5 gigawatts of data center power, or enough energy to power millions of U.S. homes, from the cloud giant. That's according to reports from Bloomberg. This deal reportedly part of OpenAI's Stargate deal, which promised that the company would partner with Oracle and SoftBank to invest $500 billion in AI infrastructure in the U.S. Oracle announced earlier this week that it had signed a cloud deal worth $30 billion in annual revenue starting in 2028 without naming the customer. And by the way, I believe Oracle shares are at or near a record today. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's Trading Tickers page. Well, stocks rising on a stronger than expected June jobs report, with the S&P 500 hitting a fresh intraday record. Yahoo Finance Fed correspondent Jennifer Schonberger has the breakdown. Hi again, Jen.
Hey, Julie. Good morning to you again. Yes, a much stronger than expected jobs report. Non-farm payroll numbers clocking in at 147,000. Much stronger than the 106,000 expected. The unemployment rate ticking down to 4.1% versus expectations to tick up to 4.3%. It had sat at 4.2% for the prior 2 months. Average hourly earnings coming in a bit at 3.7% versus what we had seen 3.839 for the past couple of months, but still holding strong. But if we look under the hood of this report, most of the job gains were being driven by state and local governments as opposed to the private sector. And businesses have been saying that they're in a holding pattern right now when it comes to hiring plans because of uncertainty surrounding effective tariff rates and immigration. I asked Labor Secretary Lori Chavez-DeRemer moments ago whether this uncertainty is weighing on businesses and if we could have seen stronger job growth if not for that uncertainty.
Always uncertainty causes a pause, but the president has done a wonderful job in these tariff talks, in this time of growing the America's economy. It's going to take some time, but he has leaned in on his executive orders. I mean, one of the directions by all of the agencies is to lean in on the workforce. So the Department of Labor, I get to do that. 1 million active apprentices, that's going to solve the growth in that manufacturing sector. But we saw construction tick up. We saw healthcare tick up. We've seen many of the jobs. I mean, I still think plus 70,000 in private sector. That's going to continue to grow as well.
All of this as President Trump turned up the heat on Fed Chair Jay Powell and the rest of the FOMC Wednesday night, calling on Powell to resign immediately. And this jobs report is unlikely to help the situation, likely to take any chances for a July rate cut later this month off the table. So we could probably see a bit more pressure, continued pressure, I should say, from the president on the Federal Reserve, as they have said clearly that so long as the job market remains strong, the economy remains strong, they can take the time to wait and see what the impact of the president's tariffs are going to be on inflation. Julie?
Jennifer, thank you. Well, the bond market has been selling off following that stronger than expected jobs print. Traders pushing out bets for rate cuts from the Federal Reserve. The odds of a July cut largely fading away, according to CME FedWatch. Our next guest sees just 1 to 2 rate cuts by the end of 2026. Here with more, Luis Alvarado, Wells Fargo Investment Institute Global Fixed Income Strategist. Luis, thank you for being here. And I should mention, we didn't just get the headline jobs report today. We got jobless claims, we got services PMI, as well as the ISM services read, which the latter came in better than estimated. So what's the backdrop then for the potential rate cuts? It sounds like you're not looking for many.
That's right, Julie. It's going to be really difficult for the Fed to move. They've told us already they're going to be on a wait and hold, waiting to see what happens with the implementation of tariffs down the road. And obviously, their biggest concern now, they're going to be focusing on that inflation goal. We got the unemployment number, payroll numbers today, like it was mentioned, and we see a market that is very resilient. So it's going to be difficult for the Fed to act. It is better for them or more prudent for them to be on a wait and hold mode to see what the final implications are going to be.
Obviously, the president doesn't feel that they should be in that wait and hold mode. And, he has kept up his rhetoric against Jay Powell. Ultimately, does that matter to markets? Will it matter, for example, if he announces a replacement for Powell well before his term is over?
Right now, we're not seeing really a lot of implications for markets, even if the president continues to rack up the attacks on Chair Powell or just the fact that he wants to lower rates. We believe even if a name is announced, just having a shadow fair, a Chet Fair, is not going to really make any difference for the committee, right? You have other voting members as well, not only the Fed chair. And then Chair Powell has pretty much said that he's going to wait until his term is up in May of 2026. So we could probably see it as another tactic, but in reality, markets are looking way past that. They want to focus on the fact that the Fed is going to remain independent. I think that is more important for the Fed. And even if, and this is a very out there scenario, something happens with Chair Powell, the other voting members of the committee, it's going to be difficult to persuade them if they're really also being independent and looking at the data.
And Luis, if indeed the Fed holds steady, I mean, I've talked to some economists today who say that even though the headline number was strong for the jobs report, some of the underlying factors still show a little bit of reason for concern. So is there a risk, if the Fed holds steady, of continued labor market deterioration while they are waiting to see what's going to happen?
To be honest, Julie, in our view, the risks are very, very minimal. The Fed can always quickly react in case something deteriorates. We get past readings. This is sort of what happened in the economy. The bigger things are yet to come. We're also on the verge of getting the One Big Beautiful bill passed. That is going to add an additional amount of stimulus, and is also going to increase the debt ceiling, which the bond market is really looking at. We know that the Treasury general account needs to be replenished. There's going to be a lot of issuance. There's issuance coming even next week as well. So the bond markets are looking at the amount of issuance that is out there and what the demand for Treasury is going to be. That component has the capacity to move, term premiums as well. And all the stimulus that is expected or has been expected for a while from this bill is potentially going to add to the growth component as well. And then if tariffs, because like you mentioned, we're still waiting on the final say on that, adds to inflation, those three components of growth, inflation, and the term premium have all the capacity to increase interest rates, towards year end 2026. It's going to be really difficult for the Fed to cut rates. And even if they did, in our view, we don't believe the market is going to swallow that or believe it. They're going to jack up rates as well.
So, Luis, all is said and done in terms of fixed income strategy, where do you think people should be looking right now?
Yes, we have been telling our clients, investors, to position themselves in the intermediate, the belly of the curve, 3 to 7 years. There's no real reason to extend a lot of duration or a lot of maturities. You can definitely collect good investment income, which is exactly what fixed income has been there. We are coming off of the first half of the year. Fixed income investors are going to look at those statements and they're going to see green, where you see fixed income has performed well. And then we are wanting investors to remain in high quality in investment grade corporates, securitized. There's no real reason to, really go down in the credit rating spectrum. You can definitely create a portfolio built of core investment grade corporate bonds, securitized, or even governments that is yielding somewhere between 4 to 6%.
Luis, thank you so much. Appreciate it.
Thank you.
Coming up, a deeper look at the state of hiring and firing in the labor market, plus how markets are responding to this morning's jobs numbers. Stay with us. We're about an hour into the trading day, so let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Our Brooke DePalma with us now. So what are you watching, Brooke?
Good morning, Julie. One strategist saying in a note this morning that if you were off the radar for the past 6 months and you came back and you read all the headlines going on right now, you'd be pretty surprised at yet another day of this NASDAQ and S&P 500 moving higher after we just hit record close during Wednesday's trading session as investors really digest three major headlines here. That looming July 9th deadline after we just heard from President Trump on Wednesday that the U.S. has reached a trade deal with Vietnam. Of course, we also have that jobs report better than expected with 147,000 jobs added, and that big, beautiful tax bill currently in the House and set to go to President Trump's desk by that July 4th deadline. But what's really leading this rally here, if you take a closer look at the YF Interactive, is the NASDAQ and S&P 500 moving higher. If you take a look at the NASDAQ over the past 5 days, once again, we are set to close at record highs. And what we're really seeing here is these tech stocks really leading the way in the markets this morning. You have Meta, Nvidia, Microsoft, Amazon, all moving higher. If you take a closer look at Meta at the open this morning, it got a bit of a boost after it got an upgrade to hold from underperform by Needham analyst Laura Martin. She said that labor productivity research shows that Meta has had among the strongest labor productivity. Also, I want to take a closer look at crude oil here. What we're really seeing there is it's hit the lowest levels since 2021 ahead of this July 4th weekend. That's a big deal here. We want to continue to see lower gas prices, keep consumers going out and spending. We know that AAA projects, get this, more than 61 million people to travel by car this holiday weekend. So that's good news, certainly, for gas prices.
Brooke, thanks much. This morning's jobs report came in with 147,000 jobs added in June. My next guest says that better than expected number does have some weakness under the surface. The pace of hiring is slowing. Microsoft, for example, just the latest company to announce thousands of job cuts. Corey Staley joining us now, Indeed senior economist. So, Corey, what are those things under the surface that you think we should be watching?
Yeah, so I mean, I think if we look even just at the headline number and we dissect it a little bit, what we can see is behind that 147,000 jobs are just a few industries that are driving it, right? Like healthcare, we saw was a big part, as it has been for the last couple of years. But interestingly enough, today we also saw that local government and public education were also pretty big adders of jobs, this month. And if we start to kind of combine those, we see that 94% of the job gains came from those few categories. So in and of itself, it says, sure, the tent might be holding up, but it's holding up with fewer and fewer posts, right? And so I think that in of itself is a concern. But then we also saw some things like the duration of unemployment picking up a little bit. We see that continually job seekers and workers who are outside of healthcare, outside of these areas that are hiring, are saying, hey, the labor market might be robust and good at the top level, but it's not necessarily working for me. And that's obviously a concern for really anybody and for the labor market in general.
And Corey, both looking at these numbers, looking at things like the JOLTS report and looking at data that you guys track on Indeed, is it taking people longer to get jobs as well?
It is. So, I mean, today in the report, we did see that the job finding rate actually picked up a little bit. So we saw that there was some encouraging sign that people are able to find jobs a little more. But if we look at what the trend has been over the last year or so, we see that hiring activity is near the lowest that it's been in a decade. We see that quitting activity is also really low. People aren't voluntarily leaving their jobs, which means they're also not opening up new seats and new opportunities for people to step into those roles. And so we are seeing that, especially if you're unemployed right now, it is taking longer to find jobs.
And Corey, what do we know about how much of this is demand versus supply? In other words, there was a lot made of the potential impact that the immigration crackdown would have on the job market, not because of demand, but because of supply. There wouldn't be as many workers for certain industries to hire. Then at the same time, there is a concern in some industries about demand for workers. So talk us through what we're seeing in both of those aspects.
Yeah, certainly. So on the demand side, there are very clear distinctions. This is a really bifurcated labor market. Again, we see that healthcare and some other in-person type of jobs are showing pretty good demand. If we look at our data, the Indeed Job Postings Index, it shows that even construction, manufacturing are still actually holding up pretty well in terms of demand from employers. But what's interesting is if we look on the flip side of that, we see that marketing jobs, software development jobs, jobs in data and analytics processing, despite AI and everything else going on, the demand has still been pretty muted there, much lower. And so we've seen this real bifurcation and separation in this type of demand. So I think that that's been really a big driver in the last couple of years. What we've seen, though, since the end of 2024, really, and even somewhat in 2025, is that the labor supply really is reaching a peak. We see labor force participation rate peaked kind of this last fall, last in September, and now we've seen that it started to fall back off. And so that's really obviously concern on the labor supply side of things. And obviously the immigration, a lot of the immigration restrictions are going to potentially have an impact there. We're not seeing a bunch of it yet in the data, but it's going to start showing up in the coming months and years. And when it does, it's going to be a headwind to economic growth.
Well, and Corey, on that front, we're at this really interesting period right now where we know, or we think we know, that things are coming. Tariff effect on prices, immigration effect on jobs, the federal job cuts that will start to have more of an effect as people actually come off the rolls. What do we have, if anything, in terms of data to help us look forward in that way? I mean, we know that the jobs report, for example, is backward looking. I mean, you guys have access to a lot of data from your site. What are you seeing that tells us a little bit more about the direction?
Yeah, I love that question because the Indeed data really is uniquely situated to speak to kind of the forward-looking real-time effects of the data that we're seeing. In our Indeed job postings index, which is updated basically as of last Friday, we can see that demand, especially in areas that have been most hit by some of the DOGE early cuts, has started to pull back. We see that scientific research, R&D type of roles have really dropped in demand since February. We see similarly among like the large contractors and companies that are receiving significant dollars from the federal government, that funding kind of drying up is also leading to fewer job postings, less hiring on that front. And so again, it maybe hasn't necessarily shown up in the jobs report, but we are seeing it in the real-time data on Indeed's site that demand is starting to pull back a little bit in some of these areas where federal cuts are starting to have an impact. Beyond that, we're also seeing more and more federal workers coming to our site. We've seen 150% more applications from federal workers since the beginning of the year because they're out looking. And like I said, there are some jobs which are just harder to find right now, especially the types of jobs that these federal workers are doing.
Corey, really interesting stuff. Thank you so much for joining us.
Thank you for having me.
Got much more action ahead. Stay tuned. You're watching Market Catalysts. The current Secretary General of the OECD is Matias Corman. He sat down with our brand new show, Morning Brief Market Sunrise. Here's what he had to say about AI and the labor market.
The upside opportunities and benefits are incredibly exciting across a broad cross-section of activities. I mean, whether it goes to, access to higher quality healthcare, education, being able to manage, our energy consumption, production consumption better, and indeed productivity improvements could be quite extraordinary and help drive stronger growth and ultimately higher incomes and living standards for people around the world. But there are a whole range of challenges and risks to be managed and to be dealt with. And, one of them being that, AI, while it's developing very rapidly, it is developing very rapidly in a comparatively concentrated way. I mean, so the diffusion of AI as a technology and the opportunities that come with it are not yet as widespread as they could be and should be in order to really optimize the benefit for people. And so what we're really saying is that we need to look at AI like a general purpose technology where it's important to facilitate universal access, where it's important that we ensure that the workforce is equipped with the skills in order to be able to participate and benefit in all the opportunities, and where indeed we protect the appropriate levels of competitive tensions in the system, that this doesn't become a technology that enables the big companies to further lock in a market dominant position at the expense of smaller players and competition and innovation and productivity improvements that come with that. So there's a broad range of issues that will need to be addressed in order to ensure that all of the exciting benefits for humanity can indeed be unlocked.
Are you not worried that perhaps artificial intelligence could take away jobs, could move people into less well-paid jobs because they're being replaced by AI?
Well, I mean, the data is not showing that it is pushing people in less well-paid jobs. It's certainly true that it will transform the labor market, and that there is a whole range of jobs that will either change or disappear, and other jobs will be created that will respond to the needs of communities and economies around the world in a different way. I mean, that's always been the case with innovation, whatever the innovation has been in the past for hundreds of years. Some jobs disappear and new jobs are created, and we do things differently, but it doesn't mean that there will be fewer jobs. It just means that the jobs will be different. And if we look at the labor markets around the world right now, I mean, if anything, there's a great level of tightness in labor markets, and we are looking at skilled labor shortages in key markets around the world. And so really what we need to do is ensure that labor markets and people, workers, are equipped with the necessary skills to be able to really take advantage of all of the opportunities.
If you're thinking of grilling for the 4th of July, you may be feeling the pinch in your wallet. The cost of a 10-person barbecue topped $100 for the first time ever last year. That's according to the annual Rabobank Barbecue Index. Yes, there is a barbecue index. With more on what's driving those prices up and how consumers can save, joined by Stu Leonard Jr. He is the CEO and president of the grocery store chain. Stu Leonard, it's great to see you. Thanks for joining us.
Hi, Julie. Well, happy 4th of July to everybody.
And to you. Always love to see you in the store talking about what's going on there. So, yeah. I mean, where are people seeing the biggest increases? I'm guessing proteins that they're throwing on the grill probably have something to do with it.
Well, you know what? A lot of the proteins right now are about the same price as last year. And overall, we haven't seen really any prices. Even with the tariffs and everything, we've been able to keep everything relatively the same. I've had to go up on a couple things, like, I make fresh guacamole over there. I have like 2 or 3 people all day making guacamole, and because of labor, I had to bump the price a little bit. But overall, prices are about the same. Ground beef, which is your big cheeseburger, hamburger meat that you use, is $3.99. Last year it was $3.99. So everything's about the same, I would say.
Are you seeing any consumers make any different choices then? If it sounds like things kind of have remained stable, are we seeing any kind of trade down effect? Because even if prices haven't changed, if people, for example, are feeling different in their own personal situation.
Well, the one thing that we definitely notice right here, which really shocks me, is take a look at this one, Julie, right here. How do you like that? Okay. This is a prime ribeye that we get from our ranchers out in the Midwest. Sales of the prime meats. Now, these are what you get in a restaurant, usually a great steakhouse. Those things, we're seeing double-digit increases in that right now for the holiday. Sort of like the Haagen-Dazs thing, even though there's a big thing about losing weight, people still eat Haagen-Dazs. So I think people are splurging a little bit. The temperament I feel in the store is pretty good. I communicate with our customers all the time. We'll have 100,000 of them this weekend coming to Stu Leonard. So I would say overall, people feel pretty good. Hey, put it in perspective, $10 for a meal at your barbecue. You could almost go to McDonald's and spend that much for lunch. It's nothing like going out to a restaurant.
Yeah, I mean, you're certainly not getting that big steak there that you showed if you're splurging. It's the holidays when I see Stu holding up various cuts of meat, right? I am curious, is there any kind of tariff feed through at this point, Stu? Because I know that, some of the deals, there haven't been the deals made yet with Mexico and Canada, but I know there are a lot of exempted items.
Yeah, there are exempted items. So what is it? The US, Canadian, Mexican agreement or whatever.
Right.
But no fresh items can be tariffed. So avocados, we're so lucky. I'll be a big item for 4th of July with guacamole. But you know what? They're coming up from Mexico right now. No tariff on them. The other big thing is our salmon coming in from Canada right now. We sell a ton of salmon. probably your number one selling fish for us at Stu Leonard. And that's no tariffs on that right now. The thing where things get dicey is like tequila. You can't buy that anywhere else in the world. They're ready to impose a 10% tariff on that. But a lot of the tequila manufacturers saw this coming and they brought in like 4 to 6 months supply. So things like that we're pretty okay with. You know, and you see things happening like in Europe right now with olive oil. There was a big crop change last year. Everybody paid a fortune for olive oil last year. You could hardly get it. This year, the price has come down in half. So even that sort of masks the tariff situation a little bit there. But overall, we're managing and trying to get through it. Our margins are very thin at our business right now in most supermarkets. The question is that, you know, what impact a little bit of these tariffs will have on our profits, basically.
Right, and I guess that's a question that has not yet been answered because they're still working their way through trying to make all these deals. Stu, finally, I would ask you, is there any item or items this year that are particularly hot that you're really seeing an uptick in for the holiday?
Well, look, I've been in this business 50 years. I mean, this is my home here, being down on the store floor. The item that I can't believe is selling as much as this is these Dubai chocolate bars. What happened here? You know, we are selling thousands, tens of thousands of them. It's like the number one item. I've never seen anything like it. It was on TikTok or something. I don't even know where it came from. But we're just going to ride this. I don't know if it's a fad or not, but Dubai chocolate bars are really hot. The other thing that's really hot is like prime beef right now. You know, that's really hot if you talk to our buyers in the store right now. So those are just a couple things that catch my eye when I walk through the store.
You gotta love the TikTok trends, Stu. Great to see you. Thank you so much for joining us, and happy 4th of July. Yeah, tell me.
Hey, thank you. If I could just say one thing. My wife and I, unfortunately, had a little 2-year-old boy that drowned in a pool 30 years ago. We've spent our life trying to, you know, teach all you young parents out there, don't get on your cell phone around the pool. You gotta have a designated watcher for your pool. But right now is drowning season. It's going to start right now. I spoke to one family already that lost their 3-year-old, ran out and fell in the pool. So be super careful right now. And you know, this is drowning season. So have a designated watcher, just like you'd have a designated driver for alcohol. Be safe.
Stu, this is a great reminder for all the parents out there and grandparents, et cetera. Thank you so much. Have a happy and healthy and safe holiday.
Thank you very much. Happy 4th of July to everybody.
Thanks, Stu. Let's turn to the travel aspect of the holiday. Now, fewer Americans are planning to travel this summer amid the trade war and economic worries. That's according to a survey by Bankrate. Also, new data from Skiplagged reflects that, showing flight prices have dropped significantly in July. Joining us for more is Octar Zamin, the CEO of Skiplagged. Skiplagged, it's a company that helps consumers find airfare hacks, most notably by skipping the last leg of a connecting flight, for a cheaper price. Thanks so much for being here.
Thank you for having me.
So, Octar, let's start with kind of what you're seeing in terms of demand, in terms of people coming to your site, actually buying some of these flights. You know, how have trends changed at all over the past few months?
Yes. So whenever there's tough economic times, people tend to look for deals. And Skiplagged is a place for deals. We are known for showing people options they won't see anywhere else. Basically, like we're known for travel hacks, notably something called skiplagging, where, as you mentioned, you simply buy more tickets than you need and you save a lot of money. On average, people are saving $180 or about 50% on their tickets. So, as the economy gets worse, like people are going to be looking for deals.
And so have you guys seen then an uptick in traffic?
Yes, we have. It generally like it's a situation where people are looking for deals, but overall, like the market is kind of declining in terms of the number of people searching for travel. So it's an interesting situation right now.
And you say on the site that this isn't something that people should do all the time, right? Because airlines don't love it. I am curious how you guys make money at Skiplagged.
So we make money from the sales. Oftentimes, there's a small little fee, but for most of the usage, we don't make money. In fact, I believe 95% of the time we don't make any money. And that's okay, because our goal as a platform is to give consumers options to help their lives improve, to help them do travel that they wouldn't be able to otherwise. We've heard from so many families about the impact of Skiplagged, being able to see their grandparents for the holidays. That they wouldn't be able to otherwise. So all these things are what make it okay for us to not make as much money as we can be, I guess.
Gotcha. And also, as I mentioned, the airlines don't like it, right? They say that this kind of thing isn't allowed. Some of them have sued your company, but they've either dropped the suits or settled with you outside of court. How have you sort of prevailed in those situations?
Yes, we are known for also fighting back against the airlines. At the end of the day, we're showing consumers flights that they wouldn't see elsewhere, that the airlines don't want them to see, because it fundamentally helps people actually save money. It really goes deep into how airlines price, which is very counterintuitive. They don't price by distance as you would expect; they price by market. We expose this to the consumers and really help them save money. And they shouldn't do this too often, because saving money is not what the airlines want for consumers. So the airlines will try to put a stop to it. The consumer is taking advantage of it too many times. But in general, we have almost 100% success rate.
Thank you so much for joining us. Appreciate it. Have a good holiday.
You too. Thank you.
That does it for today's Market Catalyst. Stick around for a new episode of Stocks in Translation, followed by Market Domination at noon Eastern.